And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Peter Krull, who's a partner and director of sustainable investing at Earth Equity Advisors with approximately 200 million in assets under management. Peter, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you so much, Adam. It's a pleasure to be here and to chat with you today.
So, Peter, I always like to begin. Can you please tell us your story and how you got to where you are today?
All right, that's a great question. I love telling this story. My degree is actually in communication. My degree is not in business or finance or anything like that. And so I started out in college doing TV production and doing TV news and stuff like that. And when I realized with my first job in college that I was making $12,000 a year and that, the upward prospects on that weren't exactly what I was hoping they would be, I went back home. I grew up in Buffalo, New York, and started working at a electronics retailer and worked with them for about 5, 6 years and, consistently got more responsibility running stores and being in charge of training for the company at one point. But when, electronics retail, there was a lot of companies that didn't make it, and the company I was with was one of them. So when that happened, I was a Merrill Lynch client at the time. I called my Merrill Lynch rep and said, "Hey, can you get me an interview?" And I was living in Roanoke, Virginia, or just outside of Roanoke at the time. And he said, "Sure." So I went in, did the interview. I guess I passed because I got the job. Went and did my Series 7, Series one of the 65 or 66, whatever that was at the time, and got into financial services and went through the Merrill training program. I really enjoyed the program. I learned a lot. And I spent about 5 years, give or take, with Merrill. At one point, I was pretty much like, I'm not necessarily, I'm cut out for this big financial services background. I went and tried being a banking investment manager for a little while. That I realized that the bank channel was definitely not for me, and so I, took a leap and hung up my shingle and started what at the time was called Krull and Company with LPL, and ran that for a while. It was at that time or just before that that I had met my wife, Melissa, who is a PhD microbiologist and molecular geneticist. So a hell of a lot smarter than me, Adam. I definitely married up. Um, and I also met a gentleman named Bill McDonough. And at the time, Bill was one of the sort of preeminent green architects in the world. And so I got to spend an afternoon with him and talk about sustainability and a lot of the things that he was focused on. And I sort of, I was thinking in the back of my mind, maybe this is something that I'd be interested in. Melissa and I were talking about sustainability and environment and conservation, things like that. And so I took the leap and I started the firm with the intention of it being a socially responsible firm. That's, SRI, that's what we called it back then. And, over the last 20 years, because, we're recording this in 2024, our 20th anniversary was this past June. So we've been
Oh,
doing this for
congratulations.
20 years now. Yeah. And so, it's been a hell of a ride. It's been a lot of fun. There's been ups, there's been downs, but I think in the end, we've had a great impact and we're continuing to scale at this point.
I love it. Well, congratulations. So before we go to my next question, I don't often get former people that have gone through training programs at big banks. Can you please, you said you learned a lot. Can you please share with us some of the things that you've learned or that stuck out in your mind?
One of the things I liked about Merrill in their training program was we got sent up to Princeton. I want to say 3 or 4 times, something like that. And, we got to interface directly with, multi-million dollar producers, billion dollar financial advisors. And I think that sort of that one-on-one interaction where you can ask questions and you can learn was really impactful. I think that, anytime we have that opportunity, that's a good thing, especially to learn from people who've already made the mistakes. I'm a big fan of somebody, or I'm a big fan of sort of the concept that, it's only a mistake if you don't learn from it. And so, being able to learn from people who have made the mistakes, sort of gives you a leg up.
Yeah, that's great. So I'm going to ask you about mistakes a little bit later, but let's talk about your investment strategy for now. Can you please let the audience know a little about what you do and some of, your investment strategy?
Sure. And of course, that's evolved over the years. We've really moved from socially responsible investing, which was sort of the concept of let's exclude the bad guys. Let's try to include the good guys. Let's use shareholder advocacy to change the ones in the middle, and let's make sure that we're doing some community investing. That was sort of the initial or the original idea of socially responsible investing, sort of the three-legged stool. And as we've sort of moved forward, a lot of people wanted to be able to quantify things. You wanted to be able to make sure that we had material numbers, and that's where ESG came into play, environmental, social, and governance metrics. One of the things that I always like to sort of educate people on is what is ESG? Because there's all kinds of ideas out there. There's all kinds of concepts of what ESG is, but at the end of the day, ESG is about risk. It's about trying to determine what the risk is on the company. What is the environmental risk on the company? What is the social risk? And what is the governance risk on the company? And unfortunately, what's happened is a lot of people who are, I don't want to say scared, but don't necessarily believe in maybe the environmental side of things. They've sort of turned it upside down and said, no, it's the risk of the company on the environment. It's the risk on social issues and things like that. And that wouldn't necessarily be material on a company because that's just sort of an externalization. But what ESG, again, at the end of the day is its risk on the company. And so just keep that in mind. So we do what I call sustainable investing. And sustainable investing, I think, is maybe a step beyond what ESG is. So sustainable investing from my perspective is a ground up philosophy. So let me to compare it with ESG. ESG is a set of metrics. Let's say you take an index, and on that index, you layer ESG metrics and you make adjustments to allocations, and you've got an ESG portfolio. It is a portfolio with less risk. That's at the end of the day, that's what it is. Whereas a sustainable portfolio is more focused on solutions. It's more focused on how do we include companies that are going to be the leaders in the next economy, companies that are, more focused on a cleaner economy, a more resilient an adaptive economy, one that's more resource efficient, and if you can, one that's more equitable.
Got it. No, makes perfect sense. So in, ESG would be more just ranking based on numbers, but you're looking for more of a bottom-up approach and a holistic approach to finding. That makes sense? Or
Absolutely.
I'm not.
Absolutely. Yeah, and yeah, again, I've been doing this long enough to have an idea of what retail clients want, and we mostly deal with retail clients. If I bought an ESG portfolio for a one of our retail clients, and they got their annual or semi-annual report and started looking through what are the holdings, and they started seeing, ExxonMobil or McDonald's or somebody like that, they're going to pick up the phone and say, "What the hell are you doing here? This is what's sustainable about either of these companies?" Well, I could explain if that's what we did, that hey, it's a lower risk, etc. Whereas what I've learned is that retail clients actually want solutions. They want to see that, hey, I might have this particular solar company, or I might have this particular company that's focused on biotech, which is making a difference from that perspective. And so that's what we've learned. So that's why we sort of crafted our portfolios from the client's perspective, because they're the ones who, at the end of the day, are the ones who want to make the impact.
Sounds great. No, that makes perfect sense. So let's talk about risk. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
So that's a great question, especially in light of sustainable investing, because if you take and throw all your assets, all your eggs, into solar and wind, you're going to have your ass handed to you potentially, because there's going to be typically more volatility. They're smaller companies, it's more of a niche or even thematic kind of investing. What we try to do from a risk perspective is be as diversified as possible. So find the companies that are in each one of the different sectors, and judge them based on how are they contributing to the next economy. Now, we don't include the energy sector because the energy sector is fossil fuels. Fossil fuels are, at the end of the day, they are the reason for our, existential climate crisis at this point. And so we won't own that. And one thing to remember is that energy, the energy sector does not include wind, does not include solar, does not include geothermal or anything like that. Those are typically going to be categorized under industrials or technology or utilities. And so, we'll exclude fossil fuels, we'll exclude the energy sector, but we'll continue to make sure that we are diversified across the board in terms of the other sectors. When I'm putting a portfolio together, I'll also typically skew towards large cap if possible. So when I'm putting together our Green Sage sustainability portfolio, for example, which is our individual stock portfolio, I'll typically try to make it about 50% large cap, 30% mid, and 20% small. So you've got opportunity for some new technologies in the small cap side, but because of its volatility, it's not going to typically give you the same amount of risk that you would, because I've got this 50% sitting in large caps.
Got it. So you diversify it by market cap, and then you also exclude certain sectors like oil or fossil fuels since it doesn't align with your core principle of sustainability.
Exactly.
Got
Exactly.
it. Okay, makes sense. Let's talk about timeless lessons. Shift the conversation a little bit to some of the timeless lessons you've learned along the way, and then the follow-up would be timeless mistakes and how do you avoid those? But if you learn from them, it's not a mistake, which I think is brilliant. But anyway, anywhere you want to go.
Um, Timeless lesson. So, I think what I just talked about is a timeless lesson. Be well diversified. A lot of times, what we'll find is, with these retail clients who really want solutions, they'll transfer their portfolios in, and I'll find that a good portion of it is in like TAN, which is the solar ETF, or FAN, which is the wind ETF. And it is so skewed to the point that it's not a well-diversified portfolio. They're not doing themselves any kind of service with that, even though they think they might be. And so, making sure that there is adequate diversification across sectors is a timeless lesson that I think everybody needs to keep in mind. And that you can find, from a sustainability perspective, you can find sustainable attributes if you're looking for them. So, for example, in the insurance industry, insurers are providers of risk. And we're going to be looking for insurers that are actually integrating climate risk into their underwriting procedures and things, because at the end of the day, they're the ones who have the biggest potential. If we look across all the sectors, they're the ones who have the biggest potential to actually push a climate friendly. I don't want to say agenda. That's not how I want to phrase it. But
Mission
they're
maybe or objectives.
yes,
Yeah,
yes,
right.
exactly. Because at the end of the day, it's their bottom line that is on the line. And so, that's one area. Another area is sort of the junction of AI and biotech, for example. You know, the AI is becoming a bigger player in biotech, because instead of say a 10-year billion-dollar new drug, which is about the average, because they're running the AI to run multiple iterations of particular drugs over and over in silico, um, it potentially can shorten up that R&D cycle. And we may get drugs that are for cancer, or for things that we really need to be addressing in a much shorter time, and also on a much shorter budget. You also ask about mistakes people make. So it's funny when I've got a report that I run when we have new prospective clients coming in, and we'll take their portfolios, put it through this Morningstar Direct report that I've created, and it shows, what percentage they have in fossil fuels, in weapons, in tobacco, things like that, things that matter to our sustainable clients. But the mistake that I don't see isn't necessarily related to sustainability. It's related to perceived diversification. And what I mean by perceived diversification is, we see a lot of people come in with, say, 10 mutual funds, and every single one of them is a large cap domestic fund.
Right.
And instead of actually having, the diversification of 10 funds, like, large cap, mid cap, small cap, international, but whatever it is, they've all got the same thing, but they have this false sense of diversification. And so understanding, and this is sort of the core of a lot of what we do, is understanding what's under the hood, understanding what is actually in the investments or the funds or ETFs that you're owning, is a big part of allocation. So, not only do we run an individual stock portfolio, but we also run multiple fund models that are based on risk, conservative, moderate, aggressive, and equity. And when I'm putting those together, one of the reports that I run every single time using Morningstar Direct is overlap. And so what that'll be able to do is that shows me, okay, if I own this particular Brown Advisory Sustainable Growth Fund, which is a domestic large cap growth fund, and I also own a small mid fund, how much overlap is there in their holdings? Or if I do buy thematic funds, which I do, to complement those portfolios, how much overlap is there between them? And my goal is to make as little overlap as possible. My goal is to make sure that if I add alts, for example, that the correlation between them and and stock and bond indexes are as low as we possibly can, because that's why we have them in there. So those are a couple of, I think, both mistakes and positives that I've experienced over the years.
That makes perfect sense. So if people in the audience that aren't familiar, alts are just another way of saying alternative investments. And what Peter's looking for is diversification. So they're not correlated to other asset classes that are in the portfolio. Is that correct?
That's absolutely right. The idea of adding, might be commodities, it might be, option strategies or other derivatives, is that they don't move in the same cycle as the stock market or the bond market, or either one of them in, either together or individually. And so when you have market cycles, like let's say in 2022, I believe it was, when both the stocks and bond markets were down, a lot of our alternative funds actually were up during that time. And so it gave us I'd like to say it sort of evens our return out over time. Sometimes it might cut off your highs a little bit, but it certainly will cut off your lows. And so, at the end of at the end of the day, our focus is going to be on how can we balance your risk, your return, and narrow that variability between the highs and the lows.
Got it. No, it makes perfect sense. You want to reduce the drawdown. So if someone's account's at 100, you get a bear market, you don't want it to go down to 50 or 30 or 20. You want it to go down as little as possible. And then when it goes up, have a nice return on the upside without having the huge
Absolutely.
swings up and down and cause people to be on that emotional roller coaster.
It's about balance, right? At the
Mm.
end of the day, we want to have as much balance as possible. And you know what? There are clients that are able to deal with those swings, and they might make a better return over the long run, but it's not going to be an easy ride getting from point A to point B.
No, it makes perfect sense. So, Peter, we have a big portion of the audience are money managers or financial advisors. You said you learned a lot of lessons and mistakes from when your training days and over your career. Let's talk about that from a money management standpoint and building a sustainable business. I like the word sustainable because it applies to sustainable investing,
Yeah,
sustainable businesses, and also for a sustainable portfolio. So,
right.
what are some timeless mistakes and or lessons specifically for money managers and or people that want to become, manage their own portfolio that you've
Right.
learned that you'd like to share?
You know, I think we tend to fall in love sometimes with our choices. Uh,
Hmm.
there's a book, and it's not going to come to me. I'll send it to you afterwards, so you can put it in show notes. But
Hmm.
this book basically talked about um, how we need to learn to let go of things at some point when they're no longer serving us. That was sort of the idea.
Hmm.
And that's probably one of the bigger mistakes that I would have learned from is, if something isn't performing for you, um, doubling up on it isn't necessarily going to help you if it's not a good investment. And so, being able to let go and not be in love with your investments is probably one of the first things. Keep what you own at arm's length, because at the what we want to do is make a as good a return as possible with as little risk as possible, right?
Hmm.
And try to remove the emotion. I think that's why a lot of folks who are individual investors will come to a financial advisor, because it's hard to separate out the emotionality, because it's my retirement, it's my kids' education, it's these things that really mean a lot to me. But if we can, as financial advisors, remove that emotionality out of it and buy a particular company, a particular fund, or whatever it is, based on its investment attributes, based on its risk level, and put it together with a group of others, to again try to reduce that volatility and maximize return as much as possible, then we're doing our jobs. So, emotionality, I think, is one of the mistakes and it's, as financial advisors, we are not immune to it. There's a particular EV stock that I absolutely love. I love what they make, but the reality is that right now it may not be the best investment for us to have as both clients or individuals as well. So that's definitely a mistake that I think I've overcome.
I love
And
that. So, yeah, sorry, go ahead.
no, I was trying to think of others that potentially could add to the story here. The what I said earlier, I think it really applies though, and there's not going to be a specific mistake here, but I think we're so scared of making mistakes. When we're hiring, one of the things that I'll typically tell folks is, don't be afraid to make a mistake. Don't be afraid to try something new. Now, if you're going to potentially lose a bunch of money, then well, let's talk about it before you make that decision. But if it is something that is a potential learning experience, go ahead and try it. If it doesn't work, it doesn't work. But you've
Right,
learned from that,
right.
and don't dwell on it once it's happened. Learn from it and move on and grow from
Love it. Well, Peter, final question for you today. What is the best piece of advice you've learned along the way or that you'd like to give your 30-year-old self?
it. This actually goes. This is something that maybe if you, I don't know if you've got college students that
We'll
watch
take it
this.
all with a please and thank you. We have a large audience. Yeah.
The the one piece of advice that I give every time, like for example, I'll go to the Clean Energy Conference at UNC over in Chapel Hill, and we always have a bunch of college students in there. And I always say, I think you all should work in a restaurant at least for a summer, at least for a semester. And they just sort of give me a weird look, and I'm like, when they're like, why? Like, because you learn everything you need to know about life. I remember growing up, there was a book, Everything I Needed to Know I Learned in Kindergarten or something like that. Well, a restaurant is the same way. You learn how to interact with people. You learn how to work under stress. You learn so many things that you wouldn't necessarily learn if you were, if you were just taking, I'm going to say a vanilla route, as you go through experiences. And that's the one thing, there is something special about going to a place and they serve you food. And we so often I'll be in a restaurant and I'll see people mistreating service, people who are working in the restaurant. And it drives me nuts because those people are doing something special for you. And I learned to treat people better because I worked in a restaurant. I learned to interact better with my fellow employees because I worked in a restaurant. I learned how to work under pressure because I worked in a restaurant. And so I think sometimes we look down on jobs like that, but those are some of the most important people that are around us. I've had some of the best experiences of my life in restaurants. And I think most of your listeners probably would agree with that as well. And so, you know, look at look at life from that perspective, from that service perspective. What can I do to help people? What can I do to make anybody's experience better? And relate it to a position of a cook, a dishwasher, a bartender, a waiter or a waitress, and try to live your life that way.
That's really powerful. I like that a lot. Peter, thank you so much for taking the time. What is the best way for people to get to know you more or get in touch with you or learn more
Sure.
about what you do?
So we've got a couple of different areas for this. So number one, earthequity.com is our website. We've got all kinds of info there. I have a podcast called Dollars and Change, the Expert's Guide to Sustainable Investing, which I absolutely, it has done really well. We're coming up on our 1 year anniversary on that.
Congratulations.
We have two lines of business. We work with individuals, but we also work with financial advisors. So we do license out our sustainable investment portfolios because the way I look at that is if you're a financial advisor and you have clients who are interested in sustainable investing, and according to the statistics, you probably do. You don't have to be the expert on that. Let us be the expert and let you be the client interface, the person who actually manages the relationship. So we really want to help lift up advisors when it comes to that, because according to Morgan Stanley, 96% of Gen X, or I'm sorry, of millennials are interested in sustainable investing. 91% of Gen Xers, my generation, are interested, and I think 85% of Gen Z are interested. So the interest is there, and as we continue to move forward, and money is handed down through, through this great wealth transition that's coming up. If you, as a financial advisor, don't have a solution for that next generation, they're going to find somebody else to do it. And so that's why we come at it from this perspective.
I love it. Well, Peter, thank you so much for taking the time today. Congrats on the podcast. I'll have links. Please send me whatever you want me to include in the description.
We'll
And
do.
hopefully have you on again soon. This was really fantastic.
Thanks, Adam. It's been a treat. And for those of you who are wondering why I'm in a bedroom, I live in Asheville, North Carolina, and we're filming this in December, or I'm sorry, in November of 2024, and our city still doesn't have potable water. So we are actually living out at our cabin right now. Again, Adam, thank you so much for having me on. It's been a pleasure.
Thank you, Peter.